Most seniors think the bank is one of the safest places in the world. You walk in, you talk to a teller, you handle your money, and you walk out without ever questioning what was said or how it was recorded. It feels routine, almost automatic, but after retirement, something changes that most people never really talk about. The way money flows, the way accounts are monitored, and even the way casual conversations are interpreted can quietly carry more weight than they used to. Because here's the reality many retirees never get clearly explained. It's not that banks are unsafe. It's that everything you say or do inside a financial system creates a trail of information. And in retirement, that trail becomes more meaningful because it reflects your entire financial life in one place. Before we go further, welcome to Professor Kingsley. If you're watching this, you're likely someone who wants to stay financially aware without confusion, without complicated language, and without unnecessary fear. If that sounds like you, subscribe to the channel right now, because what we discuss here can help you avoid mistakes that most people only realize when it's too late. Now let's talk about something very important, something that sounds simple but has a deeper impact than most people realize. After retirement, one of the biggest risks is not losing money in some dramatic way. It's actually the small, everyday things you say without thinking. Conversations at the bank, answers to routine questions, or even casual explanations about your finances can sometimes create a more complete picture of your financial situation than you intended. And once that picture is formed, you don't always see where or how it might be used in the future. So let's start with the first thing you should be very careful about after retirement. Never casually share your full financial details at the bank. This sounds simple, but in real life, it happens all the time. A bank representative might ask about your income sources, your savings, or how you manage your accounts. In many cases, these questions are completely normal and part of verification procedures. But the issue begins when the conversation becomes broader than necessary. For example, you may go in for a simple transaction like transferring money or updating account information, and in the process, you might end up discussing how much you have in savings, what other accounts you hold, or what your monthly retirement income looks like. Individually, these details don't seem harmful, but together they create a full financial profile. And in retirement, your financial profile often represents decades of work, planning, and savings. That's why being intentional about what you share matters more than most people realize. The simple rule here is not secrecy, it's relevance. If the information is not required for the specific transaction or service you are dealing with, there is usually no need to go deeper into details. Think of it like this. You are not trying to hide anything. You are just making sure that your financial conversations stay focused on what is necessary in that moment, and not everything about your financial life. And this is where many seniors unintentionally go too far, not because they are careless, but because they trust the system completely. Trust is important, but awareness is what keeps that trust balanced. Now, before we move to the next important point, let me ask you something simple. When was the last time you actually thought about how much financial information you casually share during a bank visit? Most people never even notice it happening, and that is exactly why it matters. If you're finding this useful so far, don't forget to like this video and share it with someone in your family who is retired or approaching retirement. A simple conversation like this can prevent confusion later on. Now let's move to the second important thing you should be very careful about after retirement. Never over-explain large withdrawals. After retirement, your spending pattern naturally changes. You may withdraw more money for medical expenses, home repairs, travel, gifts for family, or even just personal comfort. This is completely normal, and banks are aware of these patterns. Sometimes, when a withdrawal is larger than usual, the bank may ask a question. This is not necessarily a problem. It is part of standard financial security checks designed to protect your account. But where many retirees get uncomfortable is in how they respond. They start explaining everything in detail, not just what the money is for, but their entire financial situation. How often they withdraw, how they manage savings, what other expenses they have planned, and sometimes even future financial intentions. In most cases, none of that extra detail is required. What matters in these situations is clarity, not complexity. A simple and direct explanation is usually enough. If the money is for a medical bill, a home repair, or a planned expense, stating that clearly is all that is needed. There is no benefit in turning a simple banking question into a full financial discussion about your life. The more you explain beyond what is necessary, the more information you are adding into a system that already has enough visibility into your account behavior. And again, this is not about fear, it's about control. You are not doing anything wrong by answering questions. You are simply learning to answer them in a way that keeps your financial boundaries clear. Most retirees never receive this kind of guidance, which is why these situations can feel confusing in real time. But once you understand the pattern, everything becomes much easier to manage. Now take a moment and think about this. If a bank asks you about a transaction tomorrow, would you naturally explain everything in detail, or would you keep your answer short and focused on the purpose? That small difference in approach can change how comfortably you handle these situations going forward. Now let's continue. And this is where things become even more important for your long-term financial control after retirement. Because once you understand how to handle information sharing and withdrawals, the next level is about something even more sensitive: who actually has access to your money, and how that access quietly changes decisions over time. Let's move into the third thing you should be very careful about after retirement. Never add a joint account holder without fully understanding the consequences. This is one of those decisions that feels simple on the surface, but can completely change how control over your money works. Many seniors decide to add a spouse, adult child, or trusted family member to their bank account for convenience. The idea is usually practical. It helps with bill payments, emergencies, or situations where someone else may need access. And in many families, it works perfectly fine. But the part most people don't fully think through is what access actually means in a joint account setup. In many cases, both account holders can have equal control. That means either person may be able to withdraw money, transfer funds, or make decisions about the account depending on the bank's rules. Now pause for a moment and think about what that really means in real life. It means that convenience and control start to overlap. And once that line is crossed, it is not always easy to reverse the decision without complications. This is why financial professionals often suggest that joint accounts should never be treated as a casual family arrangement. They are not just about trust. They are about legal and financial control. And here's the part many retirees don't consider. Life situations change. Relationships change. Even good intentions can lead to misunderstandings later. That doesn't mean problems will happen, but it does mean the risk becomes higher when full access is shared without clear boundaries. In some cases, there are safer alternatives depending on your needs. Some banks allow limited access arrangements, while others offer authorization options for specific tasks. These can sometimes provide support without giving full ownership control. But the right choice depends on your personal situation, and it should never be decided in a hurry or during a casual conversation at the bank. The key idea here is simple but powerful. Once you change ownership or access rights, you are not just making a banking decision. You are making a long-term financial structure decision. And in retirement, your financial structure matters just as much as your savings itself. Now, before we move forward, think about this for a second. If someone close to you needed help managing your account, would a full joint account actually be necessary, or would a limited access option be enough? Most people never pause to ask that question, and that is exactly where mistakes often begin. If you're still following along, you're starting to see the bigger pattern here. Most banking risks in retirement are not dramatic events. They are small decisions that feel normal in the moment but carry long-term impact later. Now let's move to the fourth important thing you should be very careful about after retirement. Never ignore or leave outdated beneficiary information on your accounts. This is one of the most overlooked areas in retirement planning, and yet it can have some of the most serious consequences if left unchecked. A beneficiary is the person who may receive your account funds after your passing, depending on how your accounts are structured. On paper, it sounds straightforward. You fill out a name, and that person becomes the designated recipient. But life doesn't stay the same. People change, relationships change, and family situations evolve over time. What was accurate 10 or 15 years ago may no longer reflect your current wishes today. The problem is that many people set a beneficiary once and then never revisit it again. Years go by, life events happen, and the information on file remains unchanged in the background. What makes this especially important is that in many cases, beneficiary designations can take priority over other documents like wills. That means the bank may follow the beneficiary form on record, even if your personal intentions have changed since then. This is something that often surprises families later, especially during already emotional situations. That's why reviewing beneficiary details is not just paperwork. It is a part of making sure your financial intentions match your current life reality. And the process itself is not complicated. The real challenge is remembering to do it and understanding how important it actually is. Now take a moment and reflect. If your account beneficiary information was set years ago, would it still match your current wishes today? Or would it need an update? Most people never check until it's too late. Now we're moving into an area that has become extremely important in recent years, especially for retirees in the United States, where digital banking and scams have increased significantly. And this next point is not about banking rules, it's about how people are tricked into sharing information without even realizing it. Let's go to the fifth thing you should be very careful about after retirement. Never confirm personal or security information unless you are 100% sure you initiated the contact. This sounds simple, but it's one of the most common ways seniors get exposed to fraud attempts. And the reason is not lack of intelligence, it's trust. Most people are used to believing that if someone sounds official, they must be legitimate. But modern scams are designed to look and sound real. A phone call may appear to come from your bank. An email may look exactly like an official message. Even text messages can be copied in a way that feels completely authentic. And in that moment, when someone asks you to confirm your identity, verify your account, or update security details, it can feel normal to respond quickly. But here is the key rule that protects you more than anything else. If you did not start the conversation yourself, you should slow down before giving any information. Instead of responding directly, the safest step is to stop and verify through official channels. That means calling your bank using the number on your card, or visiting the branch in person if needed. Because here's what most people don't realize. Legitimate banks do have your information already. They do not need you to confirm sensitive details in a rushed or pressured way over an unexpected call or message. And another important thing to understand is urgency. Scammers often create pressure. They may say things like your account is locked, suspicious activity was detected, or immediate action is required. That urgency is not a banking feature. It is a psychological trigger. Real banking processes allow time for verification. Fraud attempts often try to remove that time. So the simple mindset shift here is this. Urgency plus request for sensitive information equals pause and verify. Now let's connect this to real life. Imagine you receive a call while you are relaxing at home, and someone claims to be from your bank. They already know your name. They may even know partial details about your account. They sound professional, and they ask you to confirm a code or verify identity. In that moment, many people respond automatically. But the safer approach is to end the conversation and call back using official contact details. That small habit alone prevents a large percentage of fraud cases. Now, before we move forward, think about this for a second. How often do people respond first and verify later? In most cases, it's the opposite of what actually protects your money. If you're still with me, you're now starting to see a pattern. Retirement banking safety is not about fear, it's about slowing down in the right moments and not reacting under pressure. Now let's move to the sixth important thing you should be very careful about after retirement. Never ignore account alerts, notifications, or monitoring tools provided by your bank. A lot of seniors either don't set these up, or they set them up once and forget about them. But these alerts are one of the simplest and most powerful protection tools available today. They can notify you instantly when money is withdrawn, when a transfer happens, or when unusual activity is detected on your account. And the timing here is critical, because in financial security, the faster you know something, the more control you have over the situation. If an alert comes immediately after a transaction, you can act quickly. You can contact the bank, verify activity, or stop further issues. But if alerts are turned off or ignored, problems may go unnoticed for days or even longer. And by the time someone realizes something is wrong, the situation becomes much harder to manage. This is why modern banking systems now encourage real-time notifications. Not to complicate things, but to give you visibility. And here's something important to understand. These tools are not complicated. Most of them only require a simple setup in your phone or bank app. Once activated, they quietly work in the background. You don't need to check constantly. You just need to stay informed when something actually happens. Now pause and think about your own situation. If something happened in your account right now, would you know immediately, or would you only find out much later? That difference is what makes alerts so valuable. Now we're at the final and most important part of this entire discussion, and this is where everything you've heard so far starts coming together in a practical way. Because by this point, you already understand something very important. Most risks in retirement banking are not sudden events. They are small decisions that feel normal in the moment, but can quietly shape your financial future over time. And this last point is about exactly that. Never accept bank offers, account changes, or financial product suggestions immediately without fully understanding the long-term impact. This is something many retirees experience more often than they realize. You go to the bank for a simple task, maybe updating an account, asking a question, or completing a transaction, and during that visit, you are presented with suggestions that sound helpful. It might be a new savings option. It might be a change in how your account is structured. It might even be an upgrade or adjustment that promises better convenience or benefits. And to be clear, many of these suggestions are not harmful on their own. Banks do offer legitimate services that can be useful depending on your situation. But the important issue is timing and decision-making. Because when you are sitting at a bank in a real-time conversation, it is very easy to agree to something just because it sounds reasonable in the moment. The environment feels official, the person explaining it sounds confident, and the process feels simple. But retirement financial decisions are not just about how something sounds today. They are about how it affects your money months or even years from now. Things like fees, withdrawal flexibility, account access, tax implications, or even long-term restrictions are not always fully understood in a short conversation. That's why the safest mindset is simple. If it changes how your money is stored, accessed, or managed, it deserves time, not instant approval. There is no benefit in rushing these decisions. A legitimate offer will still be available tomorrow. A useful option will still make sense after you've had time to think about it. And if something is truly right for you, it will remain right even after you've reviewed it calmly. Now step back for a moment and look at the bigger picture of everything we've discussed so far. We talked about not oversharing financial details. We talked about handling withdrawals carefully. We talked about joint accounts and how access changes control. We talked about beneficiary updates. We talked about fraud awareness and verification habits. We talked about using alerts and monitoring tools. And now we're ending with something just as important: slowing down before making financial changes. And if you notice the pattern, it's not really about avoiding the bank. It's about how you interact with financial systems in retirement. Because the truth is, most financial mistakes don't happen because people do something extreme. They happen because people trust quickly, respond quickly, or decide quickly without fully understanding the long-term effect. Retirement is different from your working years. You're no longer just building money, you're protecting it. And protection requires awareness, patience, and a little more questioning than before. Now, before we finish, let me ask you something simple but important. Out of everything we discussed today, which one of these habits do you think most seniors overlook the most? Is it oversharing details? Is it ignoring alerts? Or is it accepting bank offers too quickly? Think about that for a moment, because your answer might also apply to someone you know. If you found value in this video, share it with a friend or family member who is retired or preparing for retirement. These are the kinds of conversations that don't happen often, but they can make a real difference in how confidently someone manages their money. Take care of your financial future with patience, awareness, and confidence.